Assalamualaikum. My name is Abdul Razik. I would like to present about the topic that I've given from my lecture for the individual assignment, which is efficient markets and behavioral finance. Okay, before we going to learn this chapter, I would like to introduce the four topics that we learn in this chapter. Okay, firstly is the efficient market. Second, the evidence against market efficiency. Third, the behavioral finance. Fourth, and the last one is lessons of market efficiency. Okay. Okay, let's learn into the topic one. Efficient market. Okay, what is efficient market? Market efficiency refers to how well current prices reflect all available, reliable information about the actual value of the underlying assets. Okay, that is the definition. For the further explanation, a truly efficient market eliminates the possibility of beating the market. This is because any information available to any trader is already incorporated into the market price. Okay. As the quality and amount of information increases, the market becomes more efficient, reducing opportunities for arbitrage and above market returns. Okay. In the efficient market, there are hypotheses. So what are the hypotheses for the efficiency of the market? There are two, which are random walk theory and efficient market theory. Random walk theory. So what is random walk theory? It states that stock prices cannot be reliably predicted. The movement of the stock prices are random and there is no pattern. The prices can even be influenced by irrelevant information. So why the random is in no pattern? What if there is a pattern in the stock prices? So if there is a pattern, the investors can easily make a huge profit based on the pattern that can read easily. So for the example, in the random walk theory that I have shown here, the government's company, the stock is trading at $100. So there is a news of fire in the stock that they have traded, and then suddenly after the news, there are two unpredicted unpredicted information. Firstly, stock prices fell by 10%, and the next day the stock price fell by another 10%. It means random walk theory says that stock prices are not dependent on each other. Hypothesis in the efficient market is the efficient market theory. So what is efficient market theory means? Efficient market theory, or known as hypothesis, holds that markets operate efficiently because at any given time all publicly known information is factored into the price of any given asset. This means that an investor cannot get ahead of the market by trading on new information, because every other trader is doing the same thing. What is important of efficient market theory? It is important to note that efficient market theory does not argue that the market will get things right at any specific moment. Markets can overvalue or undervalue an asset. It argues instead that the market will get things right over time. So the main important things is market theory. The markets can overvalue or undervalue an asset. and the market value is cannot be predicted at any specific rate. There are three main forms of efficient market theory. Firstly, weak form efficiency, semi-strong form efficiency, and lastly, strong form efficiency. So these three efficient market theory I will explain on the next slide. What are the uses? Move on the next point. What are the uses of three main forms of efficient market theory? First is to facilitate statistical testing of the hypothesis. Secondly, the implication is that trading rules using this type of information cannot generate above normal profits in the long run. The main forms of efficient market theory I will be explaining one by one, starting from the weak form. Okay, for further explanation from the picture that from the example I have given, it stated that all historical prices and returns. Okay, yeah, the more explanation is, yeah, the weak form of the efficient market theory suggests that all past information is priced into securities. Fundamental analysis of securities can provide an investor with information to produce returns above market averages in the short term. But there are no patterns that exist. So it means the pattern is in a random and cannot be predictable. Therefore, fundamental analysis does not provide long-term advantage, and technical analysis will not work in this weak form. Second is the semi-strong form theory. It implies that neither fundamental analysis nor technical analysis can provide an advantage for an investor, and that new information is instantly priced into the securities. So mostly the semi-strong market theory is the most relevant one for the investor to make their own theory to analyze whether the stock prices are in good or bad. Okay, lastly is a strong form efficiency market theory. It says that all information, both public and private, is priced into stocks, and that no investor can gain advantage over the market as a whole. So strong form of efficient market theory does not say some investors or money managers are incapable of capturing abnormally high returns. This is because that there are always outliers included in the averages. So it means in the strong form, so there are maybe a possibility of the outliers in the graph when they analyze the stock prices. The efficient market theory does not say that no investors can outperform the market. So it says that there are outliers that can beat the market averages. However, there are also outliers that dramatically lose to the market. So, okay, the majority is closer to median. Okay, the next topic is the evidence against market efficiency. So there are three evidence. Firstly, I would like to explain about the stock market crash of 1987. Okay, the market dropped between 20% and 25% on a Monday following a weekend during which little surprising information was released. This is a financial crisis in most of the world, because there is a market drop between 20% and 25% on a Monday. Okay, next we move on temporal anomalies. First is January effect, and secondly is Monday effect. So what is January effect and Monday effect? So beginning in January effect, the January effect is a theory based on a pattern that analysts have seen year after year. Put simply, stock seems to fare better during January than they do during other months of the year. So generally speaking, small companies are affected most by it, as the large companies are typically less volatile. Okay, next is the Monday effect. The Monday effect is a theory which states that returns on the stock market on Mondays will follow the prevailing trend from the previous Friday. Therefore, for example, if the market was up on Friday, it should continue through the weekend and come Monday, resume its rises. So the Monday effect is also known as the weekend effect. Okay. Okay. Lastly is the speculative bubbles. So sometimes the crowd of investors can behave as a single squirrel. So what does it mean? Prices spikes as investors jump in to avoid missing the boat. For example, believing that prices will continue to rise and that an opportunity will be lost if they don't invest. Eventually, fundamentals catch up with the momentum, and after the bubble pops, the stocks going to sinks and the prices drop back to the pre-bubble level. So it means the price when it rises, if the price is falling down suddenly, it will fall down until at the at the starting level of the price. Next, we move on to the third topic covered, which is behavioral finance. There are 3 points that I'm going to explain about the topic. First is the lack of short selling causing overpriced stocks may be explained by loss aversion. So what is meant by loss aversion? Loss aversion refers to people's tendency to prefer avoiding losses to acquiring equivalent gains. For example, it is better to the investor not lose $5 than to find $5. So if they find the $5, sometimes the $5 is not so for example, if they invest the $5 and make the research and development to gain a profit out of the stock, sometimes they do not make a worse profit when they invest $5 in the stock. Next, we move on to large trading volume may be explained by investor overconfidence. So for example, when an investor has performed well in the recent past, he might conclude that he is truly skilled. While a performance streak can indicate in trading the good performance could be also due to luck. In both cases, it might cause the investor to become overconfident. So this in turn could cause him or her to make more risk and trade more. So the important message in this point is investor should not to be overconfident based on his or her past of trading, because stocks when we trade we cannot predict the future value and based on the past value. Lastly, stock market bubbles may be explained by overconfidence and social contagion. For example, a bubble occurs when the price of financial asset or commodity rises to levels well above historical norms, above its actual value, or both. So normally the financial asset will occur above the past of the price and above its actual value, or both. So basically the price will be suddenly rises. Last of the topic covered that I would like to explain is lessons of market efficiency. There are 6 lessons which I'm going to explain. First is markets have no memory. Second, trust market prices. Third, read the entrails. Fourth, there are no financial illusions. Fifth, do it yourself alternative. And lastly, seen one stock, seen them all. Okay, first I would like to explain about the lesson one, which is markets have no memory. So the definition of the markets have no memory is price changes tomorrow are independent of price changes today. So we move on to the next point for the trust market prices. The definition is in an efficient market, the current market price will capture all of the publicly available information. Thus, it is impossible for the average investor to consistently outperform the market. The third one is the reader in trails. If the market is efficient, it can tell us a great deal about the company's future prospects. Okay, for the fourth point, there are no financial illusions. It means investors only care about cash flow. Accounting changes should be irrelevant. Fifth, the do-it-yourself alternative. Investors won't pay firms to do what they can do more cheaply, such as diversification. Lastly, we've seen one stock, seen them all. The meaning is most stocks are close substitutes for other stocks. Thus, if the return on companies A falls relative to its risk, so investors will sell it and purchase the stock of company B.